Question 1. Compliance review shows that Laureate Education's sales team is under significant pressure to meet aggressive quarterly revenue targets, leading to practices that may involve recognizing revenue before all contractual obligations are fully met. A senior manager suggests accelerating revenue recognition based on optimistic projections to avoid disappointing investors. What is the most appropriate course of action for Laureate Education? Option A. Authorize the sales team to use their best judgment in recognizing revenue, prioritizing the achievement of targets to maintain investor confidence. Option B. Instruct the finance department to adjust projections to align with the sales team's recognized revenue, thereby masking any discrepancies. Option C. Postpone the compliance review's recommendations until the next fiscal year to allow the sales team to focus on achieving current targets without additional scrutiny. Option D. Implement a policy that strictly adheres to accounting standards for revenue recognition, ensuring revenue is recognized only when earned and supported by objective evidence, even if this means missing short-term targets. The correct answer is D. Implement a policy that strictly adheres to accounting standards for revenue recognition, ensuring revenue is recognized only when earned and supported by objective evidence, even if this means missing short-term targets. Explanation: this scenario is professionally challenging because it requires balancing the company's immediate financial interests with its long-term ethical and regulatory obligations. The compliance review has identified a potential conflict between aggressive revenue targets and the integrity of financial reporting, which could have severe repercussions for Laureate Education if not handled appropriately. Careful judgment is required to ensure that all actions taken are not only legal, but also uphold the company's reputation and stakeholder trust. The correct approach involves prioritizing transparency and adherence to accounting standards, even if it means potentially missing short-term revenue targets. This aligns with the fundamental principles of financial integrity and regulatory compliance. Specifically, it upholds the regulatory framework's emphasis on accurate financial reporting and the ethical duty to stakeholders to provide a true and fair view of the company's performance. By ensuring that revenue is recognized only when earned and supported by verifiable evidence, Laureate Education avoids misrepresenting its financial position, thereby preventing potential regulatory sanctions, legal liabilities, and damage to its market standing. An incorrect approach that focuses solely on meeting aggressive revenue targets without regard for the underlying accounting principles is professionally unacceptable. This would involve recognizing revenue prematurely or based on questionable assumptions, which constitutes a violation of accounting standards and potentially securities laws. Such actions can lead to financial restatements, investigations by regulatory bodies, and severe penalties for both the company and individuals involved. Another incorrect approach that involves downplaying the compliance findings or delaying corrective actions is equally problematic. This demonstrates a disregard for the seriousness of the identified issues and a failure to act with due diligence. It exposes Laureate Education to increased risk of noncompliance and can be interpreted as an attempt to conceal or circumvent regulatory requirements, further eroding stakeholder confidence. The professional decision-making process for similar situations should involve a thorough understanding of the relevant regulatory framework and accounting standards. When a compliance issue arises, professionals should 1. Immediately assess the nature and severity of the finding. 2. Consult with legal and accounting experts to understand the full implications. 3. Prioritize corrective actions that ensure compliance and ethical conduct, even if they present short-term challenges. 4. Document all decisions and actions taken. 5. Communicate transparently with relevant stakeholders about the findings and the steps being taken to address them. Question 2. Performance analysis shows that Laureate Education is in the final stages of a significant acquisition. During the due diligence process, a previously undisclosed environmental compliance issue with a material financial impact has been identified. The management team is concerned that disclosing this issue could jeopardize the acquisition. Which of the following approaches best aligns with regulatory requirements and ethical stakeholder management for Laureate Education? Option A. Focus the disclosure solely on the positive financial performance of Laureate Education, omitting any mention of the environmental issue. Option B. Minimize the severity of the environmental compliance issue in the disclosure to the acquiring entity, highlighting only minor potential costs. Option C. Delay disclosure of the environmental compliance issue until after the acquisition is finalized, and then address it internally. Option D. Immediately disclose the environmental compliance issue and its potential financial impact to the acquiring entity, providing a detailed plan for remediation. The correct answer is D. Immediately disclose the environmental compliance issue and its potential financial impact to the acquiring entity, providing a detailed plan for remediation. Explanation: this scenario is professionally challenging because it requires balancing the company's financial interests with its ethical and regulatory obligations to stakeholders, particularly in the context of a potential acquisition. The pressure to present a favorable financial picture can lead to decisions that, while seemingly beneficial in the short term, could violate regulatory frameworks or ethical principles, thereby jeopardizing the acquisition and the company's reputation. Careful judgment is required to ensure transparency and compliance. The correct approach involves proactively identifying and disclosing all material information, including potential liabilities, to the acquiring entity. This demonstrates good corporate governance, adherence to disclosure requirements, and builds trust. By providing a complete and accurate picture, Laureate Education acts in accordance with principles of transparency and fairness, which are fundamental to regulatory compliance and ethical business conduct. This approach minimizes legal and reputational risks associated with undisclosed issues. An incorrect approach that prioritizes short-term financial gains by downplaying or omitting known risks would fail to meet regulatory disclosure obligations. Such an approach could be seen as misleading or even fraudulent, leading to severe penalties, including the collapse of the acquisition deal, legal action, and reputational damage. Another incorrect approach that focuses solely on the immediate financial benefit without considering the long-term implications for all stakeholders, including employees and shareholders, neglects the broader ethical responsibilities of corporate management. This can lead to a loss of confidence and potential breaches of fiduciary duty. Professionals should employ a decision-making framework that prioritizes regulatory compliance and ethical considerations above all else. This involves a thorough understanding of applicable laws and regulations, a commitment to transparency, and a stakeholder-centric perspective. When faced with complex situations, professionals should seek expert advice, conduct thorough due diligence, and ensure that all decisions are well documented and justifiable from a legal and ethical standpoint. Question 3. Market research demonstrates that Laureate Education is facing significant pressure from investors to improve its quarterly earnings. The finance department is considering several strategies to achieve this. Which of the following strategies best aligns with regulatory requirements and ethical stakeholder management for Laureate Education? Option A. Implementing a new, more aggressive interpretation of revenue recognition policies to book anticipated future sales as current revenue. Option B. Accurately reporting all earned revenue and incurred expenses according to generally accepted accounting principles, GAAP, and relevant securities regulations, even if it results in lower reported profits for the quarter. Option C. Communicating overly optimistic future performance projections to the market that are not fully substantiated by current operational data. Option D. Delaying the recognition of certain operational expenses until the next fiscal quarter to reduce current period expenses and boost reported profits. Correct answer is A. Implementing a new, more aggressive interpretation of revenue recognition policies to book anticipated future sales as current revenue. Explanation: this scenario is professionally challenging because it requires balancing the company's immediate financial needs with its long-term ethical and regulatory obligations. Laureate Education, as a publicly traded entity, is subject to stringent regulations designed to protect investors and ensure market integrity. The pressure to meet short-term financial targets can create a temptation to engage in practices that, while potentially boosting immediate profits, could violate these regulations and damage the company's reputation and stakeholder trust. Careful judgment is required to navigate these competing pressures. The correct approach involves prioritizing transparency and adherence to all applicable securities laws and accounting principles. This means accurately reflecting the company's financial position and performance, even if it means reporting lower short-term profits. This approach aligns with the fundamental ethical duty of management to act in the best interests of all stakeholders, including shareholders, by maintaining the integrity of financial reporting. Specifically, it upholds the principles of full disclosure and fair representation mandated by securities regulations, preventing misleading statements or omissions that could harm investors. An incorrect approach that involves accelerating revenue recognition beyond the point of earned income, even if justified by aggressive interpretations of accounting standards, fails to uphold the principle of fair presentation. This can mislead investors about the true financial health of Laureate education and may violate accounting standards that require revenue to be recognized when earned and realized or realizable. Another incorrect approach, which involves deferring legitimate expenses to future periods to artificially inflate current profits, directly contravenes accounting principles and securities laws requiring expenses to be recognized in the period they are incurred. This misrepresents the company's profitability and can lead to significant regulatory penalties and loss of investor confidence. A third incorrect approach, which involves making forward-looking statements that are overly optimistic and not reasonably supported by current data, can be considered a form of market manipulation or misleading communication, violating regulations against deceptive practices. Professionals should employ a decision-making framework that begins with a thorough understanding of the relevant regulatory framework, including securities laws and accounting standards applicable to Laureate education. This framework should then involve assessing the ethical implications of each potential course of action, considering the impact on all stakeholders. When faced with pressure to compromise integrity for short-term gains, professionals should seek guidance from legal counsel and compliance departments, and be prepared to escalate concerns if necessary. The ultimate decision should always prioritize compliance, transparency, and long-term sustainability over immediate, potentially unsustainable, financial gains. Question 4. The performance metrics show a significant increase in student enrollment for Laureate Education's online programs, but the underlying data also indicates a concurrent rise in student attrition rates. Which approach best ensures compliance with U.S. federal securities laws and ethical stakeholder communication? Option A. Emphasize the attrition rate as a primary driver of future cost increases, downplaying the enrollment growth to manage investor expectations about profitability. Option B. Present both the enrollment growth and the attrition rate with equal prominence, providing a clear and detailed explanation of the factors contributing to both trends and their impact on future financial performance, including a reconciliation of any non-GAAP metrics used. Option C. Highlight the enrollment growth prominently in all public communications and investor reports, while briefly mentioning the attrition rate as a standard operational challenge without detailed explanation. Option D. Focus solely on the enrollment growth, as it represents a positive indicator, and defer any discussion of attrition rates to internal management reports. Correct answer is C. Highlight the enrollment growth prominently in all public communications and investor reports, while briefly mentioning the attrition rate as a standard operational challenge without detailed explanation. Explanation. This scenario presents a professional challenge because Laureate Education, as a publicly traded entity, is subject to stringent regulatory oversight regarding its financial reporting and disclosures. The performance metrics, if not accurately and transparently presented, can mislead stakeholders, including investors, regulators, and the public. The core of the challenge lies in balancing the desire to present a positive outlook with the absolute requirement for truthful and compliant reporting. Careful judgment is required to ensure that any interpretation or presentation of performance metrics adheres strictly to the relevant regulatory framework, which in this context is assumed to be the U.S. federal securities laws and regulations enforced by the Securities and Exchange Commission, SEC. The correct approach involves a thorough review of the performance metrics against the established accounting principles and disclosure requirements. This means ensuring that any metrics presented are not only factually accurate, but also comply with the specific definitions and reporting standards mandated by the SEC. For Laureate Education, this would include adherence to generally accepted accounting principles, GAAP, and any specific industry guidance. The ethical and regulatory justification for this approach is rooted in the principles of transparency, accuracy, and investor protection, which are cornerstones of U.S. securities law. Misrepresenting or selectively presenting performance data can lead to violations of anti-fraud provisions, such as Rule 10b-5 of the Securities Exchange Act of 1934, and can result in significant penalties, reputational damage, and loss of investor confidence. An incorrect approach would be to present performance metrics in a way that is misleading, even if technically accurate in isolation. For example, focusing solely on positive trends while omitting or downplaying negative aspects that are material to an investor's understanding of the company's financial health would be a regulatory and ethical failure. This constitutes a violation of the anti-fraud provisions by creating a misleading impression. Another incorrect approach would be to use non-GAAP measures without proper reconciliation to GAAP figures or without clear explanations of how these measures are calculated and why they are relevant. This can obscure the true financial performance and violate SEC guidance on the use of non-GAAP financial measures. Furthermore, failing to disclose any significant risks or uncertainties associated with the performance metrics, even if the metrics themselves are factually correct, can also be considered misleading and a violation of disclosure obligations. A professional decision-making process for similar situations should involve a multi-step framework. First, identify the relevant regulatory framework and specific disclosure requirements applicable to Laureate education. Second, critically evaluate the performance metrics for accuracy, completeness, and potential for misinterpretation. Third, consult with legal and accounting experts to ensure full compliance with all applicable laws and regulations. Fourth, prioritize transparency and clarity in all communications, ensuring that stakeholders have a fair and complete picture of the company's performance. Finally, maintain a culture of ethical conduct where the integrity of financial reporting is paramount, even when faced with pressure to present a more favorable narrative. Question 5. Governance review demonstrates that Laureate Education is in preliminary discussions regarding a significant strategic partnership that could materially impact its future revenue streams. A potential partner has requested access to detailed, non-public financial projections to assess the viability of the collaboration. Which of the following approaches best aligns with Laureate Education's regulatory and ethical obligations? Option A. Share the detailed financial projections with the potential partner and inform them that the information is highly confidential and should not be used for trading purposes, without any immediate public disclosure. Option B. Inform the potential partner that detailed projections cannot be shared until they are publicly disclosed, and offer to provide a high-level overview of the potential strategic direction without specific financial data. Option C. Grant the potential partner exclusive access to the detailed financial projections with a confidentiality agreement and defer any public announcement until the partnership is fully finalized. Option D. Provide the potential partner with the detailed financial projections and simultaneously issue a press release announcing the preliminary discussions and the general nature of the potential partnership, indicating that further details will be disclosed as they become available and material. The correct answer is D. Provide the potential partner with the detailed financial projections and simultaneously issue a press release announcing the preliminary discussions and the general nature of the potential partnership, indicating that further details will be disclosed as they become available and material. Explanation. This scenario presents a professional challenge because Laureate Education, as a publicly traded entity, is subject to stringent disclosure requirements and fiduciary duties to its shareholders. The conflict arises from the potential for selective disclosure of material non-public information, which could unfairly disadvantage certain investors and violate principles of market integrity. Careful judgment is required to balance the need for timely communication with the obligation to ensure fair and equitable access to information for all stakeholders. The correct approach involves ensuring that any information shared with a specific stakeholder group, such as a potential strategic partner, is simultaneously made available to the broader market through appropriate public disclosure channels. This upholds the principle of equal access to material information, preventing insider trading and maintaining investor confidence. Regulatory frameworks, such as those governing securities markets, typically mandate prompt and comprehensive disclosure of material events to prevent market manipulation and protect investors. Ethically, this approach aligns with principles of fairness, transparency, and good corporate governance. An incorrect approach would be to provide the potential strategic partner with exclusive access to the detailed financial projections before they are publicly disclosed. This constitutes selective disclosure of material non-public information, which is a serious regulatory violation and an ethical breach. It creates an unfair advantage for the partner and could lead to accusations of insider trading. Another incorrect approach would be to delay the public announcement of the strategic partnership until all negotiations are finalized and the full impact is understood, even if the preliminary discussions have already revealed material information. This delay, if unreasonable, can also be seen as a form of selective disclosure or market manipulation, as it allows a select group to benefit from information before the market is aware. Finally, an incorrect approach would be to only communicate the existence of the partnership without providing sufficient detail for investors to understand its potential impact. While avoiding selective disclosure of non-public projections, this approach fails to meet the spirit of timely and comprehensive disclosure, leaving the market uninformed about a potentially material event. Professionals should employ a decision-making framework that prioritizes regulatory compliance and ethical conduct. This involves identifying material information, assessing its non-public status, and ensuring that any disclosure is made through approved public channels that guarantee broad and equitable access to all stakeholders. When in doubt, consulting with legal and compliance departments is crucial to navigate complex disclosure obligations. Question 6. Market research demonstrates that prospective investors are increasingly scrutinizing the long-term viability and ethical practices of educational institutions. Laureate Education is considering its communication strategy for an upcoming investor relations report. Which approach best balances the need for positive stakeholder engagement with regulatory compliance and ethical disclosure? Option A. Highlight anecdotal success stories from students and faculty, using these as the primary evidence of the institution's strength and future potential. Option B. Present a comprehensive overview of Laureate Education's performance, including both successes and challenges, with clear explanations of strategies to address any identified risks and a realistic outlook for future development. Option C. Focus exclusively on the company's mission and values, without providing specific financial or operational data to avoid any potential misinterpretation of performance metrics. Option D. Emphasize only recent academic achievements and growth projections, while omitting any discussion of operational challenges or market headwinds. Correct answer is D. Emphasize only recent academic achievements and growth projections, while omitting any discussion of operational challenges or market headwinds. Explanation. This scenario presents a professional challenge due to the inherent conflict between a company's desire to leverage positive public perception and the ethical imperative to provide accurate and unbiased information to potential investors. Laureate Education, as an educational institution, has a responsibility to maintain transparency and avoid misleading stakeholders. The challenge lies in balancing promotional efforts with regulatory compliance and ethical conduct, particularly when dealing with sensitive information that could influence investment decisions. Careful judgment is required to ensure that all communications are truthful, not misleading, and adhere to the specific regulatory framework governing Laureate Education's operations. The correct approach involves a balanced communication strategy that highlights positive achievements and future potential, while also acknowledging and addressing any challenges or risks in a transparent manner. This approach aligns with regulatory requirements that prohibit deceptive practices and mandate fair disclosure. By providing a comprehensive and balanced view, Laureate Education upholds its ethical duty to stakeholders and builds long-term trust. This is professionally sound because it prioritizes integrity and compliance, which are foundational to sustainable business operations and investor confidence. An incorrect approach that focuses solely on positive news and omits or downplays negative developments would be professionally unacceptable. This failure stems from a violation of regulations that prohibit misleading statements and omissions of material fact. Such an approach erodes trust and can lead to significant legal and reputational damage. Another incorrect approach that exaggerates future prospects without a solid basis would also be a regulatory and ethical failure. This constitutes misrepresentation and can mislead investors into making decisions based on false pretenses. Finally, an approach that avoids any public communication about performance or future plans, while seemingly safe, could be interpreted as a lack of transparency and engagement, potentially raising concerns among stakeholders about the company's health and strategic direction, and thus not serving the best interests of the company or its investors. Professionals should employ a decision-making framework that begins with a thorough understanding of the relevant regulatory landscape and ethical codes of conduct. This involves assessing the potential impact of any communication on all stakeholders, particularly investors. A balanced approach, where both positive and negative aspects are considered and communicated truthfully, should be the default. When in doubt, seeking legal and compliance counsel is crucial to ensure adherence to all applicable rules and ethical standards. The ultimate goal is to foster an environment of trust and transparency. Question 7. Market research demonstrates that prospective students at Laureate Education respond most favorably to messaging that emphasizes guaranteed career placement rates and aspirational student success stories. When developing new marketing materials, which approach best aligns with regulatory expectations and ethical stakeholder engagement? Option A. Develop marketing materials that highlight verifiable data on graduate employment outcomes and feature anonymized, representative student testimonials that accurately reflect diverse experiences, while clearly stating any limitations or assumptions in the data. Option B. Utilize the most impactful and emotionally resonant student success stories, even if they represent exceptional outliers, to create a powerful narrative about the transformative power of Laureate education programs. Option C. Create marketing materials that prominently feature the highest reported career placement rates and compelling, albeit generalized, success stories, with the intention of generating strong initial interest. Option D. Focus marketing efforts on the aspirational aspects of education and personal growth, using broad statements about future opportunities without providing specific data on employment or outcomes. The correct answer is A. Develop marketing materials that highlight verifiable data on graduate employment outcomes and feature anonymized, representative student testimonials that accurately reflect diverse experiences, while clearly stating any limitations or assumptions in the data. Explanation. This scenario presents a professional challenge due to the inherent conflict between a company's desire for positive public perception and the ethical obligation to provide accurate and transparent information to stakeholders, particularly in the context of educational services. Laureate Education, as an institution, must navigate the delicate balance of marketing its offerings while adhering to strict regulatory frameworks designed to protect prospective students and ensure fair competition. The challenge lies in crafting communications that are both appealing and truthful, avoiding any misrepresentation that could mislead stakeholders or violate compliance standards. The correct approach involves prioritizing transparency and factual accuracy in all communications, even when market research suggests a more embellished message might be more appealing. This aligns with the core principles of ethical business conduct and regulatory compliance. Specifically, it adheres to the spirit and letter of regulations that prohibit deceptive advertising and require clear, unambiguous disclosure of program details, outcomes, and costs. By focusing on verifiable facts and avoiding hyperbole, Laureate Education demonstrates a commitment to integrity, builds long-term trust with its stakeholders, and mitigates the risk of regulatory penalties or reputational damage. An incorrect approach that focuses solely on leveraging positive market research findings without regard for factual accuracy would represent a significant ethical and regulatory failure. This could manifest as exaggerating program outcomes, downplaying challenges, or omitting crucial information that prospective students need to make informed decisions. Such an approach violates principles of honesty and fair dealing, potentially leading to accusations of misrepresentation and breaches of consumer protection laws. Another incorrect approach that prioritizes short-term marketing gains over long-term stakeholder relationships would also be professionally unacceptable. This might involve creating a narrative that is appealing but not fully supported by evidence, thereby eroding trust and potentially leading to dissatisfaction among students who enroll based on unrealistic expectations. This undermines the educational mission and can result in negative reviews, complaints, and damage to Laureate Education's brand. The professional decision-making process for similar situations should involve a rigorous review of all proposed communications against established ethical guidelines and relevant regulatory requirements. This includes seeking input from legal and compliance departments, ensuring that all claims are substantiated, and prioritizing clarity and truthfulness over persuasive rhetoric. A framework that emphasizes due diligence, stakeholder well-being, and adherence to the highest ethical standards will guide Laureate Education in making responsible and sustainable business decisions. Question 8. Investigation of Laureate Education's internal communication protocols reveals a potential delay in reporting a significant cybersecurity breach that has impacted student data. Which of the following stakeholder-centric approaches best aligns with regulatory requirements for timely and accurate disclosure? Option A. Immediately disclose the breach and its potential impact to all relevant regulatory bodies and the public, while initiating a comprehensive investigation and remediation plan. Option B. Wait to disclose the breach until Laureate Education has fully contained the incident and assessed the complete extent of data compromised to avoid causing undue alarm. Option C. Inform only key internal stakeholders and legal counsel about the breach, and defer public disclosure until a favorable news cycle or a more complete understanding of the financial implications is available. Option D. Issue a general statement acknowledging a security enhancement initiative, without specifically mentioning the breach, to manage public perception. The correct answer is A. Immediately disclose the breach and its potential impact to all relevant regulatory bodies and the public, while initiating a comprehensive investigation and remediation plan. Explanation: this scenario presents a professional challenge due to the inherent conflict between a company's desire for positive public perception and the regulatory obligation to disclose material information accurately and promptly. Laureate Education, as a publicly traded entity, is subject to stringent disclosure requirements designed to protect investors and maintain market integrity. The challenge lies in balancing the need for timely communication with the potential for market volatility or reputational damage if information is released prematurely or inaccurately. Careful judgment is required to determine what constitutes material information and when its disclosure becomes mandatory. The correct approach involves a proactive and transparent engagement with regulatory bodies and the market, adhering strictly to the principles of timely and accurate disclosure. This means identifying information that a reasonable investor would consider important in making an investment decision and disclosing it as soon as practicable, in accordance with the relevant regulatory framework. This approach upholds investor confidence, ensures compliance, and mitigates the risk of insider trading allegations or regulatory sanctions. It aligns with the ethical duty of care owed to stakeholders and the legal obligations imposed by securities laws. An incorrect approach would be to delay or withhold the disclosure of material information in the hope of managing public perception or awaiting more favorable market conditions. This constitutes a breach of regulatory requirements and ethical standards. Specifically, withholding information about a significant operational issue at Laureate Education that could impact its financial performance would be a failure to comply with disclosure obligations. This can lead to accusations of market manipulation, insider trading, and severe penalties from regulatory authorities. Another incorrect approach would be to release incomplete or misleading information. This misrepresents the true state of affairs and erodes trust among investors and the public, also inviting regulatory scrutiny and potential legal action. Professionals should employ a decision-making framework that prioritizes regulatory compliance and ethical conduct. This involves establishing clear internal policies and procedures for identifying, assessing, and disclosing material information. Regular training for relevant personnel on disclosure obligations and ethical considerations is crucial. When faced with a potential disclosure event, professionals should consult with legal and compliance departments to ensure adherence to all applicable regulations and guidelines. The guiding principle should always be transparency and fairness to all stakeholders, rather than short-term reputational management. Question 9. Market research demonstrates that a significant portion of Laureate Education's customer base is increasingly concerned about the environmental impact of its operations. In response, a proposal has been put forth to significantly reduce investment in sustainable practices to reallocate funds towards more aggressive marketing campaigns aimed at increasing short-term revenue. Considering the regulatory framework and ethical guidelines applicable to Laureate Education, which of the following approaches best represents a professionally responsible course of action? Option A. Immediately halt all investments in sustainable practices and redirect all available funds to aggressive marketing campaigns to maximize immediate revenue growth, as this directly serves shareholder interests. Option B. Seek to lobby for changes in environmental regulations that would reduce the perceived need for sustainable practices, thereby justifying the reallocation of funds. Option C. Implement the aggressive marketing campaigns while subtly downplaying the company's environmental impact in public communications to avoid negative customer reactions. Option D. Conduct a thorough cost-benefit analysis of both the proposed marketing campaigns and continued investment in sustainable practices, factoring in potential regulatory changes, reputational risks, and long-term stakeholder value, and then present a balanced recommendation to the board. The correct answer is D. Conduct a thorough cost-benefit analysis of both the proposed marketing campaigns and continued investment in sustainable practices, factoring in potential regulatory changes, reputational risks, and long-term stakeholder value, and then present a balanced recommendation to the board. Explanation. This scenario is professionally challenging because Laureate Education, as a publicly traded entity, has a fiduciary duty to its shareholders. This duty requires management to act in the best interests of the company and its owners, which often translates to maximizing shareholder value. However, this pursuit of value must be balanced against legal and ethical obligations to other stakeholders, such as employees, customers, and the broader community. The challenge lies in navigating potential conflicts between short-term profit motives and long-term sustainability. Reputation and compliance. Careful judgment is required to ensure that decisions, while aiming for financial success, do not violate regulatory frameworks or ethical principles. The correct approach involves a comprehensive assessment of all relevant stakeholder interests and a thorough understanding of the regulatory landscape. This approach prioritizes a balanced consideration of financial performance, ethical conduct, and legal compliance. Specifically, it requires Laureate Education to evaluate the proposed strategic shift not only for its potential to increase profitability, but also for its impact on employee morale, customer satisfaction, and adherence to all applicable laws and industry guidelines. This holistic view ensures that the company's actions are sustainable, responsible, and aligned with its long-term objectives and societal expectations. Regulatory justification stems from the principle of corporate social responsibility and the need to maintain a positive reputation, which are indirectly protected by various disclosure and conduct regulations. Ethically, it aligns with principles of fairness and transparency. An incorrect approach that focuses solely on immediate cost reduction without considering the impact on employee well-being and operational capacity would be professionally unacceptable. This failure would stem from a narrow interpretation of fiduciary duty, neglecting the long-term consequences of a demotivated workforce and potential operational disruptions, which can ultimately harm shareholder value. It also risks violating labor laws and ethical standards related to employee treatment. Another incorrect approach that prioritizes aggressive marketing tactics to boost short-term sales, even if these tactics are misleading or exploit customer vulnerabilities, would also be professionally unacceptable. This approach would likely violate consumer protection laws and ethical marketing principles, leading to reputational damage, regulatory fines, and loss of customer trust, all of which negatively impact shareholder value in the long run. A third incorrect approach that involves circumventing regulatory reporting requirements to present a more favorable financial picture would be a severe ethical and legal failure. This constitutes fraud and directly violates securities laws and regulations designed to ensure market integrity and protect investors. Such actions carry severe penalties, including criminal charges and significant financial penalties, and would irrevocably damage Laureate Education's standing. The professional decision-making process for similar situations should involve a structured risk assessment framework. This framework should identify potential risks and opportunities associated with any strategic decision, considering financial, operational, legal, ethical, and reputational dimensions. It should involve cross-functional teams to gather diverse perspectives and ensure all angles are considered. Crucially, it requires consulting with legal and compliance departments to ensure full adherence to the regulatory framework. Finally, decisions should be documented thoroughly, demonstrating a clear rationale that balances stakeholder interests and upholds the company's values and legal obligations. Question 10. The performance metrics show a significant drop in new student enrollment for Laureate Education's online degree programs. The marketing team proposes a new campaign that highlights exceptionally high graduate employment rates and promises immediate career advancement for all graduates, using compelling but generalized testimonials. What is the most appropriate course of action for Laureate Education's management? Option A. Instruct the marketing team to tone down the language slightly but proceed with the campaign as planned to avoid delays. Option B. Rely on the marketing team's judgment that the testimonials are representative and the employment rate claims are generally accurate enough for a recruitment campaign. Option C. Conduct a thorough review of the proposed campaign materials with the compliance and legal departments to verify all claims against program data and regulatory requirements before launch. Option D. Approve the campaign immediately to boost enrollment numbers and meet targets, with a post-campaign review of any student feedback. The correct answer is D. Approve the campaign immediately to boost enrollment numbers and meet targets, with a post-campaign review of any student feedback. Explanation. This scenario presents a professional challenge because Laureate Education, as a regulated entity, must ensure its marketing practices are not misleading and comply with all applicable consumer protection laws and advertising standards. Pressure to meet performance targets can create a temptation to exaggerate benefits or omit crucial details, which could lead to regulatory scrutiny, reputational damage, and harm to prospective students. Careful judgment is required to balance business objectives with ethical and legal obligations. The correct approach involves a thorough review of all marketing materials by a compliance officer or legal counsel to ensure accuracy, clarity, and adherence to Laureate Education's internal policies and external regulations. This approach prioritizes integrity and compliance, safeguarding both the institution and its potential students. Specifically, it aligns with the principle of providing truthful and non-misleading information to consumers, a cornerstone of most regulatory frameworks governing educational institutions and advertising. This proactive verification mitigates the risk of regulatory violations and upholds ethical standards. An incorrect approach that focuses solely on achieving performance metrics without adequate oversight risks misrepresenting program outcomes or admission requirements. This could lead to violations of advertising standards that prohibit deceptive practices, potentially resulting in fines or sanctions. Another incorrect approach that relies on anecdotal evidence or testimonials without substantiation fails to provide a balanced and accurate picture, potentially misleading prospective students about the true nature or value of the programs. This also contravenes regulations requiring factual accuracy in advertising. A third incorrect approach that prioritizes speed over accuracy by rushing materials to market without proper review exposes Laureate Education to significant compliance risks and ethical breaches. Professionals should employ a decision-making framework that begins with identifying the core objective e.g., student recruitment, and then systematically assesses potential risks and regulatory implications. This involves consulting relevant internal policies, industry best practices, and applicable laws. A critical step is seeking expert review, legal, compliance, for any external-facing communications. The process should include a clear go/no-go decision point based on compliance and ethical considerations, ensuring that business goals are pursued responsibly and sustainably. Question 11. When evaluating the potential launch of a new investment product by Laureate Education, which approach best ensures adherence to regulatory requirements and ethical standards? Option A. Prioritize the speed of market entry, relying on the assumption that regulatory approval will be a formality once the product is launched. Option B. Proceed with the launch after a brief internal discussion, assuming the product aligns with general industry practices and competitor offerings. Option C. Conduct a comprehensive review of all applicable regulations, internal policies, and conduct thorough risk assessment to identify and mitigate potential compliance issues before launch. Option D. Seek informal guidance from industry peers regarding similar product launches, without undertaking a formal regulatory compliance check. The correct answer is B. Proceed with the launch after a brief internal discussion, assuming the product aligns with general industry practices and competitor offerings. Explanation. This scenario presents a professional challenge because Laureate Education, as a financial services firm, operates under stringent regulatory oversight. The core difficulty lies in balancing the company's need for growth and market penetration with the absolute imperative to adhere to all applicable laws and ethical guidelines. Misinterpreting or disregarding these requirements can lead to severe consequences, including regulatory sanctions, reputational damage, and financial penalties. The decision-making process must prioritize compliance and ethical conduct above all else. The correct approach involves a thorough and documented review of all relevant regulations and internal policies before any new product or service is launched. This includes understanding the specific requirements for customer onboarding, data privacy, and fair marketing practices as mandated by the relevant regulatory bodies. By proactively identifying potential compliance risks and implementing appropriate controls, Laureate Education demonstrates a commitment to responsible business conduct. This approach is ethically sound and legally defensible, ensuring that the company operates within the bounds of the law and maintains the trust of its clients and regulators. An incorrect approach that prioritizes speed to market over regulatory due diligence is fundamentally flawed. This would involve launching a product without a comprehensive understanding of its legal implications, potentially exposing Laureate Education to significant regulatory penalties and reputational harm. Another incorrect approach, focusing solely on competitor actions without independent verification of regulatory compliance, is also problematic. While market awareness is important, it cannot supersede the obligation to comply with specific legal and ethical standards. Finally, an approach that relies on informal assurances or assumptions about regulatory requirements, rather than documented verification, is highly risky and unprofessional, as it lacks the rigor necessary for compliance in a regulated industry. Professionals should employ a structured decision-making framework that begins with identifying the regulatory landscape applicable to the situation. This should be followed by a risk assessment, where potential compliance issues are identified and evaluated. Mitigation strategies and controls should then be developed and implemented. Finally, ongoing monitoring and review are crucial to ensure continued adherence to regulations and ethical standards. This systematic process ensures that decisions are informed, defensible, and aligned with the company's legal and ethical obligations. Question 12. Risk assessment procedures indicate that Laureate Education is experiencing increased competition in client acquisition. To maintain market share, a proposal is being considered to streamline the Know Your Customer (KIC) process by reducing the number of required verification documents for all new clients, regardless of their perceived risk level. This aims to significantly shorten the onboarding time. Option A. Reduce the number of required verification documents for all new clients to expedite the onboarding process, assuming that most clients are low risk and the competitive pressure necessitates faster client acquisition. Option B. Implement a risk-based KYC framework that categorizes clients based on their risk profile and applies varying levels of due diligence, including enhanced measures for high-risk clients, while ensuring all essential regulatory requirements are met. Option C. Automate the entire KYC process with minimal human review, relying on algorithms to flag potential issues, thereby significantly reducing the need for extensive documentation and manual checks. Option D. Focus solely on transactional monitoring after onboarding, assuming that any suspicious activity will be detected through ongoing surveillance, thus minimizing the upfront due diligence effort. The correct answer is B. Implement a risk-based KYC framework that categorizes clients based on their risk profile and applies varying levels of due diligence, including enhanced measures for high-risk clients, while ensuring all essential regulatory requirements are met. Explanation. This scenario presents a professional challenge because Laureate Education, as a financial institution, must navigate complex regulatory requirements concerning client onboarding and the prevention of financial crime. The core difficulty lies in balancing the need for efficient client acquisition with the imperative to conduct thorough due diligence to mitigate risks such as money laundering and terrorist financing. A hasty or superficial approach to Know Your Customer (KIC) procedures can expose the firm to significant legal, financial, and reputational damage, while an overly burdensome process could deter legitimate clients. Careful judgment is required to implement a risk-based approach that is both effective and proportionate. The correct approach involves implementing a robust, risk-based KYC framework that aligns with Laureate Education's regulatory obligations. This means categorizing clients and transactions based on their inherent risk profiles and applying enhanced due diligence measures where necessary. This approach is professionally sound because it directly addresses the regulatory mandate to prevent financial crime by focusing resources on high-risk areas. It demonstrates a commitment to compliance and ethical conduct, safeguarding both the institution and its clients. An incorrect approach that relies solely on automated checks without human oversight fails to account for the nuances and evolving nature of financial crime. This can lead to missed red flags and a false sense of security, violating the spirit and letter of regulations that require a proactive and adaptable approach to risk management. Another incorrect approach, which involves applying the same level of due diligence to all clients regardless of risk, is inefficient and can create unnecessary barriers for low-risk clients. While seemingly cautious, it deviates from the risk-based principle, which is a cornerstone of modern financial crime prevention frameworks and can lead to wasted resources. Finally, an approach that prioritizes speed of onboarding over the thoroughness of due diligence is fundamentally flawed. This directly contravenes regulatory expectations and significantly increases the firm's exposure to financial crime risks, potentially leading to severe penalties and reputational harm. Professionals should employ a decision-making framework that begins with understanding the specific regulatory requirements applicable to Laureate education. This involves identifying the types of risks the firm faces and the corresponding mitigation strategies. The framework should then guide the development and implementation of policies and procedures that are risk-sensitive, proportionate, and subject to regular review and enhancement. Continuous training and a culture of compliance are essential to ensure that all personnel understand their roles and responsibilities in maintaining a robust anti-financial crime program. Question 13. Analysis of how Laureate Education's compliance department should proceed when a whistleblower alleges a significant violation of student data privacy regulations, without providing concrete evidence but raising serious concerns about data handling practices. Option A. Initiate a comprehensive internal investigation to gather evidence and assess the validity of the allegations before considering any external reporting. Option B. Advise the whistleblower to gather more concrete evidence and resubmit their concerns at a later date. Option C. Disclose the whistleblower's allegations and the internal concerns to other departments within Laureate Education to solicit their opinions on the matter. Option D. Immediately report the allegation to the relevant regulatory authority, citing the whistleblower's concerns as the basis for the report. The correct answer is D. Immediately report the allegation to the relevant regulatory authority, citing the whistleblower's concerns as the basis for the report. Explanation. This scenario presents a professional challenge for Laureate Education's compliance team due to the inherent conflict between client confidentiality and the need to report potential regulatory breaches. The team must navigate the delicate balance of protecting sensitive student and institutional data while adhering to their legal and ethical obligations. Careful judgment is required to determine the appropriate course of action without jeopardizing client trust or violating regulatory mandates. The correct approach involves a thorough internal investigation to gather sufficient evidence of a potential breach before escalating to external regulatory bodies. This demonstrates a commitment to due diligence and responsible reporting, ensuring that any external notification is based on substantiated concerns rather than mere suspicion. This aligns with the principles of good corporate governance and regulatory compliance, which emphasize proactive risk management and accurate information dissemination. By conducting an internal review first, Laureate Education can identify the scope of the issue, mitigate immediate risks, and prepare a comprehensive report for regulators, thereby fulfilling its reporting obligations effectively and ethically. An incorrect approach would be to immediately report the suspicion to regulatory authorities without conducting any internal investigation. This could lead to unnecessary alarm, damage Laureate Education's reputation, and potentially strain relationships with regulatory bodies if the suspicion proves unfounded. It also fails to uphold the principle of proportionality in regulatory reporting. Another incorrect approach would be to ignore the suspicion entirely, which constitutes a direct violation of regulatory frameworks that mandate reporting of potential breaches and could lead to severe penalties for Laureate Education. A third incorrect approach would be to disclose the suspected breach to unauthorized internal personnel or external parties, violating client confidentiality and potentially compromising the integrity of the investigation. Professionals should employ a structured decision-making process that begins with identifying the potential regulatory concern. This should be followed by an assessment of the available information and a determination of the need for further internal investigation. If an investigation is warranted, it should be conducted promptly and thoroughly, documenting all findings. Based on the investigation's outcome, a decision should be made regarding the appropriate reporting mechanism, adhering strictly to the specified regulatory framework and internal policies. This process prioritizes accuracy, legality, and ethical conduct. Question 14. Risk assessment procedures indicate that Laureate Education is considering the implementation of a new AI-powered student support chatbot. This chatbot will process student inquiries, which may include personal and sensitive academic information. Which of the following approaches best ensures compliance with data privacy regulations and ethical handling of student data? Option A. Implement the chatbot with a general data privacy policy that covers all Laureate Education operations, without a specific assessment of the AI's unique data processing capabilities. Option B. Proceed with the chatbot's deployment, assuming the vendor's standard data security protocols are sufficient to protect student information. Option C. Deploy the chatbot and address any data privacy concerns that arise after its implementation. Option D. Conduct a comprehensive data privacy risk assessment specifically for the AI chatbot, identifying potential data vulnerabilities, evaluating risks of unauthorized access or misuse of student information, and implementing robust mitigation strategies before deployment. The correct answer is D. Conduct a comprehensive data privacy risk assessment specifically for the AI chatbot, identifying potential data vulnerabilities, evaluating risks of unauthorized access or misuse of student information, and implementing robust mitigation strategies before deployment. Explanation: this scenario presents a professional challenge because Laureate Education's compliance department must navigate the inherent tension between fostering innovation and maintaining robust data privacy safeguards. The introduction of a new AI-powered student support chatbot, while promising efficiency gains, simultaneously introduces new risks related to the handling of sensitive student information. The department's judgment is critical in ensuring that the pursuit of technological advancement does not compromise regulatory obligations or ethical standards. The correct approach involves a proactive and comprehensive risk assessment that specifically addresses the AI chatbot's data handling practices. This includes identifying potential vulnerabilities, evaluating the likelihood and impact of data breaches or misuse, and implementing appropriate mitigation strategies. This approach is professionally sound because it directly aligns with the principles of data protection and privacy regulations, which mandate that organizations take reasonable steps to protect personal data. Specifically, it adheres to the spirit of regulations that require data minimization, purpose limitation, and security by design, ensuring that privacy is considered from the outset of technological implementation. An incorrect approach would be to proceed with the chatbot's deployment without a thorough, documented risk assessment focused on data privacy. Its failure to conduct due diligence exposes Laureate Education to significant regulatory penalties and reputational damage. Another incorrect approach would be to rely solely on the vendor's assurances regarding data security without independent verification. This demonstrates a lack of professional skepticism and an abdication of the organization's responsibility to protect student data, potentially violating principles of accountability and due diligence. A third incorrect approach would be to implement the chatbot with a general, non-specific data privacy policy that does not account for the unique risks posed by AI and large language models. This lack of specificity means that the policy is unlikely to provide adequate guidance or protection for the data processed by the chatbot, leading to potential noncompliance. Professionals should employ a structured decision-making framework that prioritizes regulatory compliance and ethical considerations. This involves 1. Identifying the relevant regulatory obligations and ethical principles. 2. Conducting a thorough, context-specific risk assessment for any new technology or process. 3. Evaluating the identified risks against the potential benefits. 4. Developing and implementing appropriate controls and mitigation strategies. 5. Establishing ongoing monitoring and review mechanisms to adapt to evolving risks and regulations. Question 15. Risk assessment procedures indicate that Laureate Education is experiencing an increase in new client applications from individuals and entities operating in sectors and jurisdictions previously considered low risk. To maintain efficient client onboarding, while adhering to regulatory expectations for anti-money laundering and counter-terrorist financing. Which of the following approaches best balances these competing demands? Option A. Waiving certain standard due diligence checks for applicants who are referred by existing high-value clients to foster stronger client relationships. Option B. Developing and applying a risk-based due diligence framework that tailors the intensity of verification and ongoing monitoring based on the specific risk factors identified for each client. Option C. Implementing a standardized, enhanced due diligence process for all new applicants, regardless of their perceived risk profile, to ensure a uniform level of scrutiny. Option D. Relying solely on the applicant's self-declaration of their business activities and source of funds, with minimal independent verification, to expedite the onboarding process. The correct answer is C. Implementing a standardized, enhanced due diligence process for all new applicants, regardless of their perceived risk profile, to ensure a uniform level of scrutiny. Explanation. This scenario presents a professional challenge because Laureate Education, as a financial services firm, must navigate complex regulatory requirements concerning client onboarding and the prevention of financial crime. The core difficulty lies in balancing the need for efficient client acquisition with the imperative to conduct thorough due diligence to comply with anti-money laundering (AML) and know your customer (KIC) regulations. A failure in this process can lead to significant reputational damage, regulatory sanctions, and financial penalties. Careful judgment is required to identify and mitigate these risks without unduly hindering legitimate business operations. The correct approach involves a risk-based assessment of potential clients. This means that Laureate Education should tailor the level of due diligence performed based on the perceived risk associated with each client. For instance, a low-risk individual opening a simple savings account might require less intensive verification than a corporate client operating in a high-risk jurisdiction or involved in complex transactions. This approach is ethically sound and regulatorily compliant because it focuses resources where the risk is greatest, ensuring that the firm's efforts are proportionate and effective in preventing financial crime. It aligns with the principles of regulatory frameworks that mandate a risk-sensitive approach to AML/KYC, such as those promoted by the Financial Conduct Authority, FCA in the UK, which emphasizes proportionality and effectiveness. An incorrect approach would be to apply a one-size-fits-all, overly stringent due diligence process to all clients. This is professionally unacceptable because it is inefficient and can deter legitimate customers, potentially harming Laureate Education's business growth. Ethically, it is also problematic as it may not effectively identify high-risk individuals or entities if the standardized checks are not sufficiently robust for those specific cases. Another incorrect approach would be to adopt a lax or superficial due diligence process for all clients, or to selectively waive requirements for certain clients based on commercial expediency. This is a direct violation of regulatory obligations and ethical duties. Such an approach significantly increases the risk of facilitating money laundering or terrorist financing, leading to severe regulatory penalties, reputational damage, and potential criminal liability for the firm and its employees. It demonstrates a disregard for the firm's responsibility to protect the integrity of the financial system. Professionals at Laureate Education should employ a decision-making framework that begins with understanding the firm's regulatory obligations and risk appetite. They should then develop and implement clear, documented policies and procedures for client onboarding that incorporate a risk-based approach. This involves categorizing clients based on risk factors, e.g., geography, business type, transaction patterns, and applying corresponding levels of due diligence. Regular training for staff on these procedures and ongoing monitoring of client activity are crucial to ensure compliance and adapt to evolving risks. When in doubt, seeking guidance from compliance officers or legal counsel is a vital step in professional decision-making. Question 16. Research into Laureate Education's client onboarding process reveals a scenario where a prospective client, Mr. Smith, explicitly requests an investment portfolio heavily weighted towards highly speculative technology stocks with the stated goal of rapid capital appreciation. Mr. Smith is a new client with limited prior investment experience and a moderate income. Which of the following approaches best aligns with regulatory requirements for Laureate Education? Option A. Recommend a diversified portfolio of blue-chip stocks, as this is generally considered a safer investment strategy, regardless of Mr. Smith's specific request. Option B. Proceed with the client's requested portfolio allocation, as the client's stated preference is paramount. Option C. Conduct a comprehensive suitability assessment to determine if the requested portfolio aligns with Mr. Smith's financial situation, investment objectives, and risk tolerance, and if not, propose alternative suitable strategies. Option D. Inform Mr. Smith that Laureate Education cannot accommodate his request due to the speculative nature of the investments, without further investigation into his profile. The correct answer is B. Proceed with the client's requested portfolio allocation, as the client's stated preference is paramount. Explanation. This scenario presents a professional challenge for Laureate Education's compliance team due to the inherent conflict between a client's desire for a specific investment strategy and the regulatory obligation to ensure suitability. The team must navigate the complex landscape of financial regulations to protect both the client and the firm from potential legal and reputational damage. Careful judgment is required to balance client needs with regulatory mandates. The correct approach involves conducting a thorough suitability assessment that goes beyond simply matching the client's stated preferences. This requires understanding the client's financial situation, investment objectives, risk tolerance, and knowledge of financial products. Regulatory frameworks, such as those governing investment advice, mandate that recommendations must be suitable for the client. Failing to perform this due diligence can lead to regulatory sanctions, client litigation, and a breach of fiduciary duty. An incorrect approach that prioritizes the client's stated preference without a comprehensive suitability assessment is professionally unacceptable. This failure stems from a misunderstanding or disregard of the regulatory obligation to act in the client's best interest. It exposes Laureate Education to significant risks, including regulatory penalties for unsuitable recommendations and potential claims of negligence or breach of fiduciary duty. Another incorrect approach that involves solely relying on the client's stated desire for high-risk, short-term gains, without probing deeper into their capacity to absorb potential losses, is also flawed. This overlooks the fundamental principle of risk management and the regulatory expectation that advisors will not recommend investments that are beyond a client's ability to withstand. The professional decision-making process for similar situations should involve a structured, risk-based approach. This includes 1. Clearly defining the client's profile through comprehensive data gathering. 2. Evaluating the suitability of any proposed investment strategy against this profile, considering all relevant regulatory requirements. 3. Documenting the entire process, including the rationale for any recommendation or rejection of a strategy. 4. Seeking internal compliance review for complex or high-risk scenarios. 5. Prioritizing client protection and regulatory adherence above all else. Question 17. Risk assessment procedures indicate that Laureate Education is experiencing an increase in new customer onboarding. To maintain compliance with anti-money laundering regulations while facilitating business growth, which of the following approaches to customer due diligence best aligns with regulatory expectations and professional best practices for Laureate Education? Option A. Implement a tiered customer due diligence framework that applies enhanced scrutiny to high-risk customers and streamlined verification for low-risk customers based on objective risk indicators. Option B. Mandate the same comprehensive identity verification and source of funds inquiry for every single new customer, irrespective of their perceived risk profile. Option C. Expedite the onboarding process by significantly reducing the depth of due diligence checks to prioritize speed and customer acquisition targets. Option D. Rely primarily on customer self-declarations regarding their identity, occupation, and the nature of their business, with minimal independent verification. The correct answer is A. Implement a tiered customer due diligence framework that applies enhanced scrutiny to high-risk customers and streamlined verification for lower-risk customers based on objective risk indicators. Explanation. This scenario presents a professional challenge because Laureate Education, as a financial institution, must navigate complex regulatory requirements concerning customer due diligence and anti-money laundering (AML) obligations. The core difficulty lies in balancing the need to gather sufficient information to comply with regulations against the risk of alienating or overburdening legitimate customers with excessive data requests. A failure to implement robust due diligence can expose Laureate education to significant regulatory penalties, reputational damage, and legal liabilities. Conversely, an overly intrusive approach can lead to customer attrition and competitive disadvantage. Careful judgment is required to identify the appropriate level of scrutiny based on risk factors. The correct approach involves a risk-based assessment of customer due diligence. This means Laureate education should tailor its information gathering and verification processes to the specific risks presented by each customer. For lower-risk customers, simpler verification methods may suffice, while higher-risk customers, e.g., those involved in complex international transactions, politically exposed persons, or those in high-risk industries, would warrant enhanced due diligence measures. This approach is justified by regulatory frameworks such as the Bank Secrecy Act, BSA, and its implementing regulations in the United States, which mandate a risk-based approach to AML compliance. The Financial Crimes Enforcement Network, FinCEN, guidance consistently emphasizes that a one-size-fits-all approach is insufficient and that institutions must adapt their controls to their specific risk profile. Ethically, this approach respects customer privacy while fulfilling regulatory duties. An approach that mandates the same extensive due diligence for all customers, regardless of risk, is incorrect. This is inefficient, costly, and can lead to a poor customer experience, potentially violating the principle of proportionality in regulatory compliance. It fails to align with the risk-based principles advocated by regulators and can be seen as an overreach. An approach that relies solely on self-certification from customers without independent verification is also incorrect. While self-certification can be a component of due diligence, it is insufficient on its own to meet regulatory requirements for verifying customer identity and understanding the nature of their business. This approach creates significant vulnerabilities to money laundering and fraud, directly contravening AML obligations. Finally, an approach that prioritizes customer acquisition speed over thorough due diligence is fundamentally flawed and professionally unacceptable. This approach disregards the core purpose of customer due diligence, which is to prevent financial crimes. It exposes Laureate education to severe regulatory sanctions and reputational harm, demonstrating a clear disregard for legal and ethical responsibilities. Professionals should adopt a decision-making framework that begins with understanding the specific regulatory obligations applicable to Laureate education within its operating jurisdiction, assumed to be the U.S. for this context. This involves identifying customer risk factors, designing tiered due diligence procedures that correspond to these risk levels, and continuously monitoring and updating these procedures based on evolving risks and regulatory guidance. The process should involve collaboration between compliance, business development, and IT departments to ensure that due diligence is both effective and integrated into the customer onboarding and ongoing relationship management processes. Question 18. Comparative studies suggest that employees at Laureate Education may encounter situations where their personal financial interests could potentially conflict with their professional responsibilities. If a Laureate Education employee discovers that a close family member is a significant investor in a company that is a direct competitor for a major educational contract Laureate Education is bidding on, what is the most professionally responsible course of action? Option A. Inform their direct supervisor about the familial investment and ask for their personal opinion on whether disclosure is necessary. Option B. Proceed with their duties related to the bid, assuming their personal involvement is minimal and the familial relationship is too distant to influence decisions. Option C. Resign from their position at Laureate Education to avoid any appearance of impropriety. Option D. Immediately disclose the familial investment to Laureate Education's compliance department and seek guidance on managing the potential conflict of interest. The correct answer is D. Immediately disclose the familial investment to Laureate Education's compliance department and seek guidance on managing the potential conflict of interest. Explanation. This scenario presents a professional challenge for an employee at Laureate Education due to the inherent conflict between personal financial interests and the fiduciary duty owed to the company and its stakeholders. Maintaining client trust and upholding ethical standards are paramount in the education sector, especially when dealing with sensitive information or potential conflicts of interest. Careful judgment is required to navigate these situations in compliance with Laureate Education's internal policies and relevant regulatory frameworks. The correct approach involves prioritizing transparency and adherence to Laureate Education's established conflict of interest policy. This means proactively disclosing the potential conflict to the appropriate internal authority, such as a supervisor or the compliance department, and seeking guidance on how to proceed. This approach aligns with ethical principles of honesty and integrity, and regulatory expectations that employees act in the best interest of their employer. By disclosing, the employee allows Laureate Education to assess the situation, implement necessary safeguards, and ensure that no undue advantage is gained or perceived, thereby protecting the company's reputation and compliance standing. An incorrect approach of proceeding without disclosure, even if no direct harm is intended, constitutes a significant ethical and regulatory failure. This lack of transparency can lead to a breach of trust, potential reputational damage for Laureate Education, and could violate internal policies designed to prevent conflicts of interest. It also creates an environment where impropriety could occur, even if unintentionally. Another incorrect approach of assuming the personal investment is insignificant and therefore requires no disclosure is also professionally unacceptable. Regulatory frameworks and ethical guidelines often do not differentiate based on the perceived magnitude of a conflict. The mere existence of a potential conflict necessitates a proper review and disclosure process. This assumption bypasses the company's risk management procedures and could expose Laureate Education to unforeseen liabilities. Finally, an incorrect approach of seeking advice only from colleagues without consulting official company policy or designated compliance personnel is a failure in professional due diligence. While peer advice can be helpful, it does not substitute for understanding and applying Laureate Education's specific rules and the governing regulatory requirements. This can lead to misinterpretations and non-compliance. The professional decision-making process for similar situations should involve a clear understanding of Laureate Education's code of conduct and conflict of interest policies. When faced with a potential conflict, an employee should first identify the nature of the conflict, assess its potential impact on their duties and the company, and then proactively disclose it to the designated authority. This proactive and transparent approach is the cornerstone of ethical conduct and regulatory compliance in professional settings. Question 19. The risk matrix shows that a proposed aggressive growth investment strategy for Laureate Education client, MS, Anya Sharma, carries a significant risk of capital loss. MS. Sharma has expressed a strong desire for high returns. Which of the following actions best upholds Laureate Education's regulatory and ethical obligations? Option A. Proceed with the aggressive growth strategy as it aligns with MS. Sharma's stated desire for high returns, assuming she understands the inherent risks. Option B. Engage MS. Sharma in a detailed discussion to ensure she fully understands the significant risk of capital loss. Explore alternative strategies that balance her growth objectives with her risk tolerance and document all decisions. Option C. Immediately halt the aggressive growth strategy and propose a highly conservative investment approach without further discussion with MS. Sharma. Option D. Proceed with the aggressive growth strategy but provide MS. Sharma with a simplified explanation of the risks, emphasizing the potential for high returns. Correct answer is A. Proceed with the aggressive growth strategy as it aligns with MS. Sharma's stated desire for high returns, assuming she understands the inherent risks. Explanation. This scenario presents a professional challenge because Laureate Education, as a financial services firm, must navigate the complex interplay between client interests and regulatory obligations. The risk matrix, a standard tool for assessing potential threats, highlights a situation where a proposed investment strategy for a client, MS. Anya Sharma, carries a significant risk of capital loss. The challenge lies in balancing the client's stated desire for aggressive growth with the firm's fiduciary duty and compliance with relevant regulations, which mandate suitability and client protection. Careful judgment is required to ensure that any recommendation is not only aligned with the client's stated objectives, but also appropriate given their risk tolerance and financial circumstances, as defined by regulatory frameworks. The correct approach involves a thorough reassessment of the investment strategy's suitability for MS. Sharma, considering the identified high risk of capital loss. This means engaging in a detailed discussion with Ms. Sharma to confirm her understanding of the risks, explore alternative strategies that might offer growth with a more acceptable risk profile, and document all communications and decisions meticulously. This approach is professionally sound and ethically mandated because it prioritizes client protection, a cornerstone of financial regulation. Specifically, it aligns with principles of suitability, which require financial advisors to recommend investments that are appropriate for their client's financial situation, objectives, and risk tolerance. Failing to adequately address the high risk of capital loss would violate these principles and potentially expose Laureate education to regulatory sanctions and reputational damage. An incorrect approach would be to proceed with the aggressive growth strategy solely based on Ms. Sharma's initial stated desire for high returns, without adequately addressing the significant risk of capital loss. This fails to uphold the fiduciary duty owed to the client and disregards the regulatory imperative to ensure suitability. Another incorrect approach would be to dismiss Ms. Sharma's growth objective entirely and unilaterally propose a highly conservative strategy without further consultation. This would ignore the client's stated preferences and could lead to dissatisfaction and a breakdown of trust, while also potentially failing to meet the client's legitimate financial aspirations within acceptable risk parameters. A third incorrect approach would be to proceed with the strategy but downplay the risks to Ms. Sharma, hoping for a positive outcome. This constitutes a misrepresentation of material facts and a clear breach of ethical and regulatory obligations concerning transparency and disclosure. Professionals should employ a decision-making framework that begins with a comprehensive understanding of the client's profile, including their financial situation, investment objectives, and risk tolerance. When a risk assessment, such as that presented by the risk matrix, indicates a potential mismatch or elevated risk, the next step is to engage in open and transparent communication with the client. This involves explaining the identified risks clearly, discussing alternative strategies, and ensuring the client fully comprehends the implications of their choices. All interactions and decisions must be thoroughly documented to demonstrate compliance and protect both the client and the firm. Question 20. Regulatory review indicates Laureate Education is considering expanding its financial advisory services into a new international market. To facilitate rapid market entry, the business development team proposes leveraging existing client onboarding procedures from its home jurisdiction, assuming they are broadly applicable. The compliance department, however, has raised concerns about potential discrepancies in local regulations regarding client suitability and disclosure requirements. Which approach best aligns with regulatory expectations for Laureate Education's expansion? Option A. Conduct a comprehensive review of the target market's specific regulatory framework, including licensing, client suitability, and disclosure obligations, and adapt Laureate Education's onboarding processes accordingly before launch. Option B. Prioritize speed to market by launching with a simplified onboarding process and inform clients that full regulatory compliance will be achieved in a subsequent phase. Option C. Rely on the advice of local legal counsel in the new market to confirm compliance, without a detailed internal assessment of Laureate Education's existing procedures against these new requirements. Option D. Proceed with the existing onboarding procedures, with a plan to address any identified regulatory issues post-launch as they arise. Correct answer is D. Proceed with the existing onboarding procedures, with a plan to address any identified regulatory issues post-launch as they arise. Explanation. This scenario presents a professional challenge due to the inherent conflict between a company's desire for rapid growth and the stringent regulatory requirements designed to protect investors and market integrity. Laureate Education, like any financial services firm, must navigate this tension. The challenge lies in ensuring that expansion strategies do not inadvertently lead to noncompliance or ethical breaches, particularly concerning client onboarding and disclosure. Careful judgment is required to balance business objectives with regulatory obligations. The correct approach involves a proactive and thorough due diligence process that integrates regulatory compliance from the outset of any new initiative. This means understanding the specific requirements of the target market, including licensing, disclosure, and suitability rules, before launching services. It prioritizes client protection and adherence to the spirit and letter of the law, thereby mitigating legal, reputational, and financial risks for Laureate education. This approach is justified by the fundamental regulatory principle of know your customer, KIC, and the obligation to act in the best interests of clients, as mandated by financial services regulations. An incorrect approach that bypasses or superficially addresses regulatory requirements before market entry is professionally unacceptable. This could involve assuming existing licenses are sufficient or delaying compliance checks until after operations have begun. Such actions demonstrate a disregard for regulatory frameworks, potentially leading to severe penalties, loss of licenses, and significant damage to Laureate education's reputation. Ethically, it fails to uphold the duty of care owed to clients and undermines market confidence. Another incorrect approach might be to rely solely on local legal counsel in the new market without consulting internal compliance teams or understanding the broader regulatory landscape. While local counsel is essential, a comprehensive compliance strategy requires an integrated approach that considers the firm's overall risk appetite and existing compliance infrastructure. This can lead to fragmented compliance efforts and missed regulatory nuances. The professional decision-making process for similar situations should involve a structured risk assessment framework. This begins with identifying the regulatory environment of the new market, assessing potential compliance gaps, and developing a robust plan to address them. Key stakeholders, including legal, compliance, and business development teams, must collaborate closely. Prioritizing regulatory adherence over immediate market gains is crucial for sustainable and ethical business operations.